Hi friends, welcome to my channel. So today we will understand the basic difference between the fundamental analysis and the technical analysis and how to use these for the stock selection. So the fundamental analysis is a process of learning about a company's business and evaluating its performance in order to determine the company's future performance. Few of the great fundamental investors are Warren Buffett, Benjamin Graham, Charlie Munger, etc. Over the long term, a fundamentally strong company's stock price tends to appreciate, thereby creating wealth for its investors. To give a perspective of a fundamental analysis of a company, if we had bought a 1 lakh worth of shares in Eicher Motors in 2009, which was almost the price of one Royal Enfield Bullet, by now we would be having more than 75 lakhs worth of shares. This is the power of fundamental analysis and long-term investment. But this doesn't mean that all the companies have given massive returns like this. There are companies like Reliance Power, Suzlon Energy, which gave negative returns for the investors. The fundamental analysis, to an extent, helps to separate the investment grade companies which create the wealth from the companies that destroy the wealth. All the investment graded companies have a few common attributes that set them apart. Likewise, all the wealth destructors have a few common traits which are clearly visible. To be a fundamental analyst, the basic skills which we need are understand the basic financial statements, understand the industry in which the business operates. Coming back to Eicher Motors, if you see the charts, the fundamental analyst who had invested in 2006 would have made near to zero returns till 2009. So the actual move of Eicher Motors started from 2010 only. So the only way an investor sticks on to the investment he made is his conviction towards his analysis. But this is where the technical analysis also helps, as the technical analysis helps in catching the short-term trends. As a result, combining the fundamental and the technical analysis will help an investor be more successful in the stock market than relying solely on one of them. The key tools that are required for the fundamental analysis are 1. The company's annual report. This can be downloaded from the company's website for free. 2. Is industry related data. For example, if we are analyzing Infosys stock, then we should be aware of the IT industry growth in India and what are the competitors for Infosys in the area and how Infosys is performing as compared to its competitors. These will help in understanding the future growth of the industry as well as the company. 3. Access to the news. Daily news helps us to stay updated on the latest developments in the industry as well as the company. Now, a lot of options are available in the online itself, like the Business Line, Money Control, IG.com, to keep us updated about the news. These are the only things that are needed to do a good fundamental research of a company. A person who is a fundamental analyst will stay invested and will not react to the short-term market movement. Also, a fundamental investor keeps his money invested to get the benefit of compounding. Compounding, in simple terms, is the ability of money to grow every year exponentially. For example, if we are investing 100 rupees, which is expected to grow at 10% a year, then at the end of the year, the expected return will be 120 rupees. For the second year, the interest which we are going to get is for 120 rupees and not for 100 rupees. That means after 2 years, the money will grow to 120 plus 120 into 10%, which is 132 rupees. In the third year, it will be 145 rupees. So this is the power of compounding. In the compounding effect, the longer we stay invested, the faster the money works for us. All the investments made based on the fundamental analysis require the investors to stay committed for the long term. The investor has to develop this mindset while he chooses to invest. A fundamental analysis can be actually divided into two. One is the qualitative analysis and another one is a quantitative analysis. The qualitative analysis involves studying about the management, their education qualification, their background, whether the management is involved in any scams, bribery, etc. A red flag is raised when any of the above factors do not fall in the right place. Basically, the qualitative analysis is more based on the quality of the company and its owners. The quantitative analysis involves only matters related to the financial numbers. Few of the parameters for the quantitative analysis are the probability, the earnings, how much debt the company has, cash reserves, dividend payouts, cash flow from various activities, asset growth, financial ratios, etc. There are many more numbers and they can vary depending on the industry. For example, for a retail industry, the total number of stores, the average sales per store, profitability for each item, etc. might be the main metrics to look at. But for the oil and gas industry, the main revenue will be based on the oil to natural gas revenue ratio, the exploration cost, the production growth, etc. Even though it is difficult to be a fundamental analyst, in the long run, the fundamental analysts are the wealth builders in the stock market. So coming to technical analysis, it's mainly used for trading on a particular stock or index that helps us to decide the entry price, the exit price, and the risk. To understand how a technical analysis is different from the fundamental analysis, we will try to understand this through an example. Imagine that we are traveling to a foreign country where everything, including the language, the culture, the weather, and the food, is new to us. So consider that on the day one, we want to have a dinner. To our surprise, there is a food street which has more than hundreds of vendors selling different varieties of food. Everything looks different and interesting, but we are clueless about what to eat. Also, we cannot ask around as we do not know the local language. Well, now we have two options. Option 1, we could visit a food vendor and find what are the ingredients used, figure out the cooking style, taste a bit, and how clean the place is, and then determine if we like the food. We do this exercise across a few vendors, after which we will most likely eat at a place that satisfies us the most. The advantage of this technique is that we know exactly what we are eating since we have researched it independently. However, we cannot scale it as we cannot go to all the 100 vendors and do this. So probably we could test this with a maximum of 4 to 5 vendors and choose one of them to have the dinner. In option 2, we could stand in a corner and observe all the vendors. We try and find a vendor who is attracting the maximum crowd. Once we find such a vendor, we make the simple assumption that this food vendor might be serving the best food. And so, we go to this vendor for the dinner. The main advantage of this method is scalability. But the flip side is the crowd need not be always right. So in the world of stock markets, option 1 is similar to the fundamental analysis where we research a few companies thoroughly and then invest our money in them. Option 2 is similar to the technical analysis where one scans for opportunities based on the current trend or the market's preference. In the technical analysis, we place trades based on the market participants' action. The actions of market participants can be visualized in the charts. If we analyze the charts properly, then we would be able to identify the buying or the selling interest by the market participants. There are few chart patterns which will happen very frequently in the stock market, and these patterns have been called as the candlestick patterns. The candlestick patterns helps a trader to understand the probable movements of that particular stock. We will learn about the candlestick patterns in the upcoming videos. So to summarize, a technical analysis is basically used to identify short-term trades. For long-term investments, it's always advisable to use a fundamental analysis. A fundamental analyst can use technical analysis to get the correct entry and exit points, but a technical analyst need not know anything about the fundamental analysis to trade in the market. As the technical analysis trades are short-term trades, don't expect a huge returns within a short duration of time. Also in technical analysis, if a trade goes bad, then always remember to cut the losses and move on to identify the next opportunity. So that's it friends. Hope you got some value from this video. If you like these kind of videos, please consider to subscribe, like and share the videos. Thank you for watching. Have a wonderful day.